Welcome back to another episode of Key Factors Podcast. I'm your host, Mark Jones, and we've got a pretty good one today. It's been a little while since I've been on or behind the camera, and I thought this was a great opportunity to bring this back. But before we move forward with our topic, I want to introduce some guests that we have today to talk about this topic. First off, I want to introduce, we've got Dylan Shively.
What's up, guys?
Yeah.
You're watching from my live right now, too?
And then we want to bring a professional that fights for us when we go to bat anywhere in Congress, things of that nature. I mean, gosh, you pretty much have fought the good fight for quite some time. Yeah?
Yes. No, thank you, Mark. It's great to be back. I feel like I've been doing this, fighting for mortgage professionals and real estate professionals in the industry since before it was cool.
Absolutely.
So it's actually been, I think, 11 years now since I testified before Congress, literally on issues like this.
Absolutely. So with our topic today, we are discussing the event that took place a couple of days ago, which was the CFPB has fined Freedom Mortgage for kickbacks, for improperly using the MSA agreement and referrals, basically paying to play. And there's a lot of things that go into this discussion. But before we start, I kind of wanted to describe what the kickback is and how it's interpreted in a grand scale. So kickbacks is defined and how it works and examples of it. So what a kickback realistically is, it's illegal, guys. You're basically paying to play. I will give you, what is that considered, quid pro quo?
Yes.
Yeah, right.
Scratch my back.
But
I'll scratch
there
yours.
you go.
Yes.
But I know somebody that does it.
Yeah. So that basic concept has been around for quite some time, and it's been frowned upon throughout our industry, but it doesn't mean it's not actually happening. And I believe one that is in the industry, and more so now I'm producing, it's easy in this market to fall at the hands of this kind of ploy, you know? So I want to get you guys' thoughts. Let's dive right into it, you know?
You want to go first?
Sure.
Go for it.
I think right now, or I don't think, I know this. People are hungry. And when I'm saying that, people are hungry, whether it's in real estate, whether it's in mortgage, title, insurance, it doesn't matter. So as an industry, at least from the lending side, we went from 4.5 trillion in home loans just a couple years ago to we're not even going to hit 1.5 trillion this year.
Right.
So a massive dive off the cliff. And so with that, you've got people that are desperate. When people are desperate, they start saying, hey, what do I got to do to get some business from you?
Yeah.
How can I get some referrals from you? Can I pay for your leads? And we share the leads. Can I pay for them? And you send me that business.
Yeah.
So it's definitely become more prevalent. I was pleased when I saw that this case popped up because I think it was more than anything else, I think a shot across the bow
Absolutely.
from the Bureau to remind everybody that, hey, we are going to be coming after you if you're violating the law.
Right. Now, John, you had mentioned something before we jumped on here discussing how the CFPB, their hands were tied during the Trump administration, and we didn't see very many cases like this, any fines come about. Why is that? What is the concept behind that?
You actually saw like virtually none. And you know, the Trump administration came in and quite frankly, they did a good job on a lot of things. To a certain degree, I think they did great with the Bureau from the standpoint of, hey, we really do need to clean house. The Bureau was coming down by saying they were going to rule by enforcement rather than by telling people what the speed limit was.
Right.
That was problematic. But instead of the pendulum swung all the way to the other side where there was just basically virtually no actions taken against anybody. So with that, everybody started, going a little bit faster and going a little bit faster and going a little bit faster. And then
especially in Texas.
Yeah.
Yeah. When you don't know what the speed limit is, you're going to continue to push those limits.
Very true.
And we saw that. And, if you're pushing those boundaries and you're not getting caught and there's no consequences, well, it's just going to continue to one up and keep going and keep going and keep going. And we see that throughout the industry. It's not limited to here locally. It's nationwide.
Yep.
And so now we're on the other end of that spectrum. Well, now there's not a lot of business.
Correct.
In the grand scheme of things.
Being honest.
There's more realtors by 600,000 than there are homes for sale in this nation right now. I mean, that's crazy to think. So,
but yet at the same time, you have, let's say, Zillow, who's selling 9 million leads in a year, and only 600,000 of them actually close. So therefore, they're just paying and paying and paying.
Yeah.
And realtors everywhere are looking for people to help them with that. Right.
Yeah.
And that's where it starts, that whole snowball effect of, hey, let's get you a part of my Zillow. And next, it's not enough. So let's get you into my office.
Right.
And then that's not enough. So let's get you on the whole company level, but we're going to do an MSA. And we'll get into MSA here in a bit. But I wanted to dive into the exact scenario that the CFPB came forth with the fines. It was 1.7 million. 1.75 million.
Yeah.
Directed at Freedom Mortgage, and then another 200,000 that was
Realty
imposed
Connect.
on Realty Connect. Correct. Salo, do you have the visual of that actual? It would say CFPB. Would say CFPB fines Freedom Mortgage, one of those Freedom Mortgage Corporation. There it is. There it is. On August 17th, 2023, the Bureau issued an order against Freedom Mortgage Corporation, Freedom, known as a residential mortgage loan originator and service headquartered in Boca Raton, Florida, for providing things of value, including subscription services, events, and monthly marketing service agreement payments in exchange for referrals of mortgage loans in violation of the Real Estate Settlement Procedures Act, which is RESPA. And it is implemented Regulation X. The order requires Freedom to stop its unlawful activities and pay 1.7 million civil money penalties. The CFPB separately took action against Realty Connection USA, Long Island, Inc. Long Island, that's odd. Boca Raton to Long Island. Right. And a real estate broker firm based in New York for accepting things of value from Freedom Mortgage referrals. The order against Realty Connection also required them to stop its unlawful activities and pay a civil money penalty of $200,000. Boom.
So let's hit this home, though. For just to, I want to hammer that point home.
Yeah.
The real estate company got popped here, too.
Yes.
I mean, most of the time when these things have happened in the past, I think it was in 2017, there was the big Prospect case.
Yeah.
And Prospect Mortgage, they were big back then, but they got fined like $4.5 million.
Correct.
And the real estate company got fined like $80,000. I mean, it was minuscule compared. So, again, here, nobody's immune.
Right.
I mean, if you're breaking the law, you're going to get caught.
And I think that brings the one point that kind of really sparked this, where I was saying, and again, for anybody who doesn't know, I just stick to credit, but I like learning about everything in real estate. So I feel like in order to be a good value to everybody, I have to understand how all this works, which is why I'm coming from a place of wanting to learn and get more of the professional's opinion, but still adding a personal touch to it. It doesn't matter if you're on the giving end or the receiving end, they're coming after both.
Correct.
Because when I made the post in those real estate groups and stuff, and we'll go through some of the comments later, a lot of the things I was getting was, well, that wasn't enough. They should have did more. I hear you, but we'll get there. And then they're like, oh, this happened to other companies and other companies. It doesn't matter because it'll wind up coming to yours eventually if you're in that practice.
Correct.
Excuse me. This is made to bring an awareness of you're not
immune to it.
You're not going to be excluded. It doesn't matter if you're the one receiving money. What this statement says is if you're playing wrong, nobody's safe.
Correct. And I think on the actual monetary value or monetary amount that they put forth was $6,000 a month that they were paying, added up to a total of $90,000 in 2 years or whatever that math adds up to.
So $200,000.
Right. So it's not like they were flying under the radar. That's a small amount when you deal with all the money that goes out of a mortgage company and back in. $6,000 is what landed them 1.75 pop.
Yep.
That's and imagine not enough to startle you.
And imagine being on the paying end of that. So they were already paying $6,000 a month, and then had to also, damn, we got caught paying $6,000 a month, so now we got to do 1.75.
Right.
And I thought it was pretty cool on the CFPB side because I always got curious where that money always went.
Sure.
But they did put it strictly in there. They have a victim relief fund. So they're the ones who are issuing out the money back to people who have either overpaid or been scammed by something. And
correct. Now, one thing that I guess I don't fully quite understand is what you're talking about here is $1.75 million. How do we show that these customers were victims of what was happening between the mortgage company and
Like,
the real estate company?
how do you know
if they closed on a loan, if they closed on a house, et cetera?
Like, how do you know that they were steered, that specific customer?
Right.
My guess, I mean, I'm no, and you'll probably have way better than me. I think at least the starting point would be when they can identify this is when they started paying people and this is when they stopped. And they'll start with that group of people because they're most likely in the window of time.
Sure.
And what happens after, I don't know, but I'd imagine that'd be the starting point.
Well, that's one of the, I guess, beauties of the new disclosures we have. The closing disclosure flat out says, here's the loan officer. Here's the mortgage company. Here's the title agent. Here's the buyer's agent. Here's the seller's agent. So it's not difficult to go and do some analytics.
Yeah.
Right.
I mean, I could look up online today and see, oh, well, this realtor is doing business with that loan officer and multiply that by however much.
Right. The MMI tools and things of that nature that we have. I guess it's just one of those things that if you get caught doing this, it doesn't matter if you harmed them or not. It's the what is it?
It's the malintent behind it.
Right. It's
exactly.
You were speeding. You broke the law.
Yes.
Plain and simple.
You could have affected them this way, but regardless, it's illegal.
And some people can make the comparison too that, hey, same mortgage company. One branch was working with an MSA. The other branch over here is not. Odds are that the branch with the MSA probably had higher rates and fees than the branch that does not.
Right.
Because that money comes from somewhere.
Absolutely. That's right.
You don't just have money, poof, available to spend.
Correct.
Which means ultimately that, there were some consumers being harmed. In
that makes perfect sense. Well, for those of you that are tuning in that don't quite know what an MSA agreement is.
Yeah, because on mine, we have a lot of consumers too.
Right. So a marketing, and what it stands for is marketing service agreement. And what is intended to be done is that mortgage company with the real estate company that is receiving the funds is supposed to do X amount of marketing for you, is X amount of exposure for you. They're supposed to put you on the front lines, and those are determined based on the agreement itself. Am I missing anything there?
No. It's just that it is an advertising agreement. So I'm going to, hey, for you to put my flyers all over your office and have a billboard here, and maybe let me rent some office space over here. There is a value to that.
Correct.
So am I paying a fair value for that?
Right.
Is like the other real question.
Right.
So that's where it starts to get a little bit gray.
So in setting these MSAs up, the intent, I believe, is good. But what ends up happening is all the checks and balances that go into verifying that each party is doing their part to the MSA starts to get a little laxed. And at that point in time is when it's totally seen as paying to play. And there's different variations of this. One, for example, matter of fact, the only type of marketing agreement that I've had in my history is a desk rental. We had a desk rental in Lofty-Hilger Group for a couple of years, and we had to get measurements of the square footage of the space. We had to comp it out to make sure that we were paying a fair market value. And then we had to report how often somebody was in that space to justify us paying for those. Obviously, things like lock and key and things of that nature to keep the files safe. Luckily for us, we were already paperless at that time. But I can see how this can be easily viewed as you're paying us for business, And what I found by switching my philosophy many years ago of leading with value is you don't necessarily have to worry about that if you're connecting with the folks. So another example or scenario is we've had folks in the past that come to us with this, and I'm like, I'm not interested. Why? You'll get all our business, blah, 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 blah. Well, chances are we're going to get the initial pizzazz of being there.
Yep.
But at the end of the day, we're only going to get business from those that like, know, and trust us, period. Right? I mean, you come in and you say, hey, you've got to use this person first. Sure, they'll send you the first one. But then after that, if they don't like you, if they don't like the way that you do business, what you provide on a value aspect, they're going to go back to their other lender that they've been working with.
And the lender is still paying the same amount. So like, is there ever any audit of like, hey, we notice we're getting less business, so we're going to cut you lesser of a check.
In the grand scheme of things, you can't do that because
Right.
it's not based on deals.
Exactly.
And that's the reality is I'm going to look at it and go, well, wait a minute. I'm renting this office space here and we got no business.
Mm-hmm.
Why am I renting
What are we
here?
paying for?
Yeah,
Right.
There's no point for
Right.
it from a business decision standpoint.
Yeah.
So, and where you're going, Mark, is 100% true. Is really it boils down to why don't we all just do our jobs and do a really good job at it? One of my favorite
What a weird concept.
One of my favorite books is Michael Mayer's 7 Levels of Communication, right?
Okay.
It's all about building out a honest, genuine, referral-based business and providing value that's not monetary or greasing wheels.
Correct.
Sorry, go ahead.
Oh, no, I was just going to say, because at the end of the day, if I do a good job for you, you're going to get more business because that transaction was awesome and smooth and
Right.
man, we got to do this again. So, there's a better way to do it than having to pay to play.
I agree 100% with that. What were you going to say there?
I was going to say pretty much almost what he said, but just like a little bit different of a twist is also think about, okay, right now, and I want to try to get into some of the mind of some of the realtors. And by the way, if you're watching this and we haven't said it yet, please go ahead and comment, any of your thoughts of what we're saying, comment any questions of what you have. And if you're watching this, please make sure to share it so other people on your newsfeed can be watching this too.
Absolutely.
So let me just get that one thing out of there. And thank you for everybody who's tuning in, who's watching on the replay, and all the people who shared it.
Mm-hmm.
But back to this, if there's any realtors that are on this live right now, and you can even comment after, but if you're on this live right now, I want to get into your mind for a second, and I can only do so much. So I need you to share with us through the comments so we can answer your questions. I want to get into your mind for a second. I understand that real estate, being a realtor, is 100% commission. So when you don't sell anything, you don't make anything. And it seems very enticing to take that lender's money when they're like, we're going to hook you up with this to help you drive business.
Right.
But don't discount the lender who doesn't. If overall, what if they can save your client more money, whether it's in fees or having a better rate, if they treat them better and they're helping you build your business, you can also go to sleep at night a little bit better, I would imagine.
Right.
If you know that the reason you referred them is because you know they're going to do a good job for your client, not because it's going to do a good job for your pocket.
Right.
Right? Because ultimately what happens is if you take care of the client and you put them with the right people, like the lender and title and everybody that also equally takes care of the client,
Sure.
You're naturally going to get more referrals by doing the right thing. And you're creating a momentum where you don't have to worry about where your next check is coming from. Because when you operate in a place of authentic and genuine and doing the right thing, you essentially manifest all of the dollars that you need, and then you don't feel bad about accepting any of them because you weren't influenced by the initial check.
Right.
Is there a way to drop that mic?
Unscrew it real quick.
Don't drop that one. So one thing that I wanted to add is, and this is just logic. If you have a mortgage company that is paying to play, right? They don't say it, nothing like that, but it's in contract, marketing service agreement, desk rental, joint venture, things of that nature. Chances are that the loan officer that they're going to give you out of the company is more times than not going to be experienced. Why? Because that lender itself is hungry for business. They don't normally know how to go out and get it just yet. They don't have the value that a seasoned veteran expert would be able to provide. So they're using this as a crutch or almost as a stepping block to getting to the next phase. But should you be the person that falls victim to that because your customer is going to be the overall not beneficiary, almost the opposite of this?
So let's do this because I want you to keep going on that. Let's not be a podcast or episode of people who just talk about, and we're going to continue to talk the problem because I like talking shit and it's fun. But at this moment in that very thought, could you continue for the inexperienced lender or realtor that's watching right now? How could they do it the right way without having to take that money? Any advice you guys would want to give?
Absolutely. I mean, I love this because I've been hiring new to the business loan officer for the past 4 years. And the one thing that, and it goes off to multiple things, is start with the basics. I mean, be there for open houses, be available for them, be honest. If you don't know the answer to a question, tell them, I don't know. But good thing for you is I've got an awesome team of resources to be able to get you the right answer quickly. That in itself shows a lot of folks that you can be honest, that you're a person of your word and that you can learn. And learning kind of breeds growth in itself because you're uncomfortable enough to be able to say, I don't know the answer to that question. But you know what? I do know somebody that does know the answer to that question. And then from another value standpoint, goodness, there's a lot.
Go for it.
I was going to say, there used to be these things before we had iPhones called networking events. and where I'm going with that too, right, is there's thousands of different personalities out there.
Sure.
And you're not going to want to do business with everybody. You're going to want to do people that you like you, that you know what, you just match.
Yep.
And the only way you're going to find that match is if you get out there and network and interview people and talk to them and find out if you like them or not, versus somebody influencing you to use somebody else that you may or may not like.
Correct.
So there's that component.
Now to add on that, because I'm glad you brought that up. So throughout this, you guys may see me grab my phone at some point, because when I made the original post about this, it got a lot of attention where people started DMing me that I've never met before, realtors, lenders, and they're explaining situations of things that happen with them. And we'll get to that in a little bit. But I wanted to bring this one up because you just said like, hey, go to networking events, get connected with people, talk with them, have a genuine conversation, get interest in them, learn about them.
Mm-hmm.
But what happens when that lender who's so excited to do it goes up to that agent that maybe they did some Facebook stalking prior, or we'll call it market research now, right? So they're doing some market research on this agent they want to work with or this team they want to work with. They go to approach them and, hey, my name is so-and-so. They're like, oh, cool. Nice to meet you. Oh, I'm a lender with, and then they get the cold shoulder because they're getting paid to only use that. And that's the problem here is what I'm trying to say.
Totally get that. Yeah. Totally get that.
I'd see it, and I would just say, don't take it personally.
Right.
It's this is where your grit comes in. This is just you just being in sales. I mean, you're going to get cold shoulders every once in a while. Don't take it personally and continue to show up.
Yep.
Because, at some point, your integrity and your hustle is going to pay through.
That's a great point. And I think I wanted to add one more thing to your initial question is what can a new, inexperienced loan officer do to gain business of realtors? Mm-hmm. And it's something that I implemented day one, 2012, when I first jumped into this business, is do more marketing than the realtors do. Mm-hmm. Put yourself out there more than the realtors do. Mm-hmm. Why? Because we've transitioned into a generation of folks that are actually figuring out you got to get pre-qualified first.
Yeah.
So therefore, if the consumer that is wanting to purchase a home stumbles upon your content, whether it's stuff that somebody has told you, you regurgitated, but took the time to actually make it into a pretty video, script, etc., chances are that's your opportunity to capture a new customer because they are looking for their options first prior to going to the realtor.
Yep.
It's just one of those things that was eventually going to happen. COVID made it way more prevalent and more easily accessible. And we're seeing the concept of, hey, realtor, I want to earn your business, but I'd like to do a deal with you first. Here's a pre-approved buyer. Go show them a house. Let's work together on this one. Mm-hmm. And that's something that realtors are not used to. I mean, it blows my mind to give a deal to a realtor and they say, I've never had a mortgage lender give me a deal. I'm like, wait a minute, what? How is that even possible? Right. This far along in the game,
It's because they're only giving them to the people they have the MSA with.
well, and that inexperienced loan officer may not even have been taught either.
Sure. Right, or exposed to.
They actually have their own database.
Mm-hmm. Yep.
I'm going old school here. I mean, friends, family, church, job, camp, you name it.
Absolutely.
So people.
And I've had loan officers new to the business come to me with the concept of, hey, this real estate group would like me to be their lender, but it's going to be $2,000 a month, and I'm going to be a part of their customer appreciations, parties, blah, 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 blah. And it's like, wait a minute. So you're going to be a part of the customer appreciation parties of people that you've never even closed? Tell me how that makes any sense. But it's just taking the time to explain all of that to them because these are things that they didn't think about. They just went, wait a minute, I can be the preferred? Mm-hmm. Okay. $2,000.
It sounds good.
Well, I don't have that. Let me go talk to my manager. Mm-hmm. So yeah, I mean, there's plenty. Now, we can go down the road. So when I was researching this, I used Bard, Google's new tool, and pulled up a bunch of different scenarios. Could you throw that on the screen real quick? There's plenty, and this is probably one of the largest. It's not the largest, but there are plenty of other scenarios to which the CFPB went after folks. Here's another one that you see on the screen, Prospect Mortgage. This was March of 2023. They were fined $3.5 million for violating RESPA's paying for real estate brokerage.
That was actually in 2017, just FYI.
This one?
Yeah, the Prospect one.
You know what? There's another one.
Okay.
This is their second time.
They didn't learn the first time.
Because I did go further. There's a total of like 50 some odd cases that the CFPB has fined this same exact RESPA violation.
There was a title company up there.
That title company, but I think it has to do with you didn't learn the first time.
Oh, yeah.
So now we're really going to pop you.
Yep.
But they all seem to be around the same logic. And I'm not here to say that MSA is a bad practice or an illegal practice. It's when you don't follow the MSA rules and guidelines that it becomes seen as pay for play. And you may start the MSA on the right track. You may start the MSA with the right intentions, but if you get lackadaisical on documenting, on providing the value and exchange of services, then it becomes pay for play all day long, you know? And that happens quite often. And it just, I don't know, blows my mind. I haven't paid anybody for leads. Matter of fact, we created our own lead generation, but it's one of those things that I lead with value.
Yep.
If we can't, matter of fact, I will talk to you about new to the business loan officers will come to me and say, okay, I'm going to meet a realtor for lunch. And I will instantly say, are you sure you want to meet him for lunch?
Because you know you're paying.
Yeah. Why do you want to meet him? Well, yeah, that makes him comfortable and we can talk and all that jazz. And my goal is to flip the mindset to why don't you meet in the office? Talk about business, talk about your goals, get a basic understanding of each other and what you can do together, what you provide in value, what they provide in value, and how you can make that flourish into something long lasting. And then if it works out, then go to lunch.
Yeah.
But there was a situation to which I made up my mind one day. I don't remember how long ago it was. Shout out Patrick Hammonds. We were sitting at lunch and I told him, I'm not here to pay for your lunch. And matter of fact, I don't want you to pay for my lunch either. I want us to have earned so much business together that we're fighting over the check.
There you go.
And it was like, and the next year we crushed it together. It was like back in 2017, something like that. But that same philosophy, that same concept, I've not only implemented, but now carried forward to other loan officers that I've coached and mentored. And it works pretty well because the other recipient knows that you're about business. They know that you're here to provide value. They know that you're not going to be that person that's just going to cut the check at the end of the day. So
that's why I always laugh when I look at numbers and I see people. I know people that are in MSAs and they're not getting as much business as they should be getting, considering the amount of money they're paying.
Yep.
Right. So I mean, it's definitely you might be covering some bills, but you're not providing value to the individual agents.
Because also. My bad. Go ahead.
No. So that business is going elsewhere.
I was going to say, on top of that too, just from things that I've seen, because again, with us, we work with a lot of real estate companies and mortgage companies, and they wouldn't get as much business as the person that's showing up because sometimes they think that they bought and earned that right.
I don't have to work as hard for it.
Right. So they stop showing up to do the things that earns the business, not understanding that, hey, the real estate company just got new realtors that just showed up. Hey, they got new things going on and new events, and you haven't been into an event in 8 or 10 months because you think, well, this check earns me the right of all the business. So and real quick, what I wanted to do.
Let me throw you a softball before that.
Go ahead.
So we're on here talking about mortgage companies, real estate companies. You're on the outside on the credit side.
Yeah.
You can get business from each one of us, right?
Yeah. Send me your business, please.
So
how much?
Ooh, there's no, that's not where I was going. So why does it behoove you to be on here advocating for something that could end up harming your referral base?
Because at the end of the day, I'll stick up for doing what's right, even if I lose business. Because the business that I would lose isn't the business I want anyway. So I believe in a fair playing ground.
Yeah.
Right. So I'm fighting for the guy or the girl or the company that is like, hey, I want us to have a value competition in what we can do in product and service and pouring into each other and helping each other grow and develop, not who could write the biggest check.
Absolutely.
Because I don't want you to send me business because I send you a check. I want you to send me business because you know that my service is going to be good and that you know, like, and trust me enough that I'm going to do the right thing for your client and I'm going to make you look good. So whatever business I'm about to lose because of it, that's fine because I didn't want it anyway. I don't want to work with the people that are paying behind the scenes because hey, when shit gets real tough and nobody has any money to dish out, then what?
Hey, Saulo, can that?
No, and you nailed it there, by the way, with the no like, and trust.
Yep.
Yeah, it matters.
Yeah.
It absolutely matters. That's why I like what you were saying before. Hey, you could be writing the check, but at the end of the day, if someone likes that lender more and trusts them more and did more deals with them, they're going to get the business over the one paying the check.
Absolutely.
Right. And, so if anything,
and it happens every time
for the, and for the ones that are paying the check or receiving the check and you're watching this, cause I know there's always one. Hopefully you take this as we're not coming after you. We're not bashing the people that write the check. Take this as oh shit, the other people writing the check are getting in trouble and I'm going to have to write a bigger one for the ones I'm already writing.
Yeah.
Let me go change my strategy so then that way I can offer more value to people and figure out what that value exchange looks like rather than the money exchange. Because again, when you don't have money to give out, what's your value
left?
proposition at that point?
You've depended upon the money for so long that you've forgotten how to do the basic steps. Presenting a class, education, those types of things. And since the camera's on me, I want y'all to know we brought the rain.
So, and I'm going to just again add one more chunk on there.
Go ahead.
From a lender perspective.
Please.
Right now. The secondary market is broken, for lack of a better word, right? Mortgage rates are super high right now.
Can you explain that just for a moment?
Yeah.
Because you probably have the best perspective of that.
No, for sure. So, of course, everyone right now, we're hearing about, oh my God, rates are at 7.5%, right? Even the talking heads on TV are saying rates are at 7.5%. Well, of course, that's 740 FICO score, 20% down, blah, 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 blah.
Right.
But the problem is, with that, there's no premium to be paid on the secondary market for these loans.
Right.
Meaning that 7.5% comes at a cost, a discount point that's going to need to be paid. Where perhaps, as much as just 3 years ago, there was huge premium. So there was like no closing cost that the borrowers would have to pay.
We could even pay some of the closing costs. They call it premium pricing.
Right. Yep. That's gone right now because the people that buy these loans know that, well, this economy's already on the downslide, right? They know that rates will be coming down within the next 2 years, which means all these loans are going to refinance. So why would I, as an investor, want to pay a premium for something that's going to pay off in 2 years? They're not.
Right.
And so where I'm going with that is that's why mortgage loans right now are expensive to consumers. That's why everybody's begging for seller concessions right now to help cover the closing cost of what it costs for that borrower to get. And Lord help you if you got below a 640 credit score right now.
Yeah.
It's challenging. So where I'm going though is that if that lender that has the MSA, they're paying for this, there's no premium in these loans right now. So where's that money coming from?
The borrower,
the consumer.
That's right.
Or the seller,
Or
right?
the seller,
where we're getting closing
Through
costs
the
from.
fees.
So if I'm expecting to get future referrals based on what a great job I did for my client, and I'm sitting in a place where they're going to be paying higher interest rates and more closing costs versus the other one that's down the street where they're going to pay less, probably get probably close faster. I mean, there's a whole
skinnier margins,
everything else, right? So, which side of the fence do you want to be on that side if you're in the perspective of giving a referral out?
That's right. That's exactly right. And just to layman that concept that John was just speaking about is if you were going to purchase a 30-year backed loan and expecting 30 years of interest for loaning this money, but yet rates are going to drop, consumers are going to refinance, thus paying your loan off way sooner than its maturity date, wouldn't you want a little bit more skin in the game? And that's kind of what he's talking about there.
Yeah, no, that's perfect because typically a servicer of a mortgage loan isn't going to make that premium back for at least 5 years.
Right.
So I want that borrower to be paying on this mortgage for 5 years, but that's not going to happen right now because I have a feeling that we'll be seeing rates lower here for sure within the next 12 months.
Did you want to talk about some of those questions before we get into how this kind of conveys to the builder world?
Yeah, so we're gonna get there too. I just wanted to address real quick, right? Because people are taking the time to watch this live. And I just wanted to go through, not that there was a lot, but just a couple comments in there to address the people that are in. I'm going to skip a couple of them and go right to the one from Bethany because she says, why does Dylan have an iPhone in his hand and I don't?
He doesn't.
You should know better. Look at the back of this. An iPhone can never. Look how good this looks. An iPhone can never. Yeah. Anyway, somebody's gonna cancel me, but whatever. Anyway, so Drew says here, right? It's Drew from Thrive.
Okay. Yeah. Drew.
So Drew says CFPB is also going after lead sellers too.
Yep. Yeah,
right. So. Do we want to go on that for a minute and then we'll get into the...
Absolutely. That's a great topic, which is why Review My Mortgage has changed its concept to a mortgage.
Wait, what is Review My Mortgage?
That is pretty good. Thank you. Yet again, for the past 4.5 years, my partner and I have been working on a consumer direct educational tool, which could have been seen as lead generation or consumer to lender connection. We have since received some pretty substantial investment opportunities into the company, and we're now going to be shifting it to a consumer education tool that the goal is all loan officers will be utilizing this so that the consumer front-facing can self-diagnose with all the programs that you as the company offer. And as we know, new loan officer in the business, maybe even older veteran loan officer in the business doesn't know all programs, all products. And for that reason, there's opportunities that are missed left and right all the time. When we're in an environment to where rates are high, well, you use program to educate the consumer, program to let them know how much money they're leaving on the table to accomplish that goal in itself. So this tool will transparently allow the lender to see what's happening behind the scenes on what the consumer's picking, what they're being self-diagnosed with, and their accurate programs that lender offers to the consumer or to the consumers, for that matter. So yeah, I mean, that's lead generation is something that you are paying for X amount of leads per lead or per month for X amount of inboxes for yourself. Whereas Review My Mortgage started off as something that you pay for marketing territory to be a part of that program, that territory, that specialized bond that we were marketing to consumers nationally, and it just puts you front and center for them. So mind you, it still works for that purpose as well. Yeah.
In do you have anything to add to that?
I was just going to say, not like Zillow.
No, not like Zillow. Not like Zillow. I mean, Zillow in itself started as a lead generation company and is still a lead generation company.
Yeah, they are.
They make most of their money from selling leads. Back to the stat that I said at the beginning of this, and that was a true stat. It was, I don't know the accurate numbers, but it was like 9 million leads that they sold, but only 500,000 of them actually closed. But yet realtors are still ready, willing, and able to stroke that check to them every month.
Yep.
You know,
because sometimes it's not their check.
That's true. That is very true. And another point is once you start that machine, that wheel, it's hard to stop the wheel. You have to almost pay more if you want
to get out.
Yeah.
It's like getting jumped out.
Correct. Yeah.
One other thing that I wanted to bring up to go back on the credit side of things, because in conversations I'll have with people when they ask me, well, why would I want to send it to you and delay the process other than, close my client now and let them figure it out later?
Yeah.
Right. Because that happens a lot in my space.
I can believe that.
So I just want to say this super clear for anybody who's watching at any point. And I can't speak for everybody who does what I do. This is only just a thought process of us until I'm sure somebody who watches me is going to steal this anyway, but you heard it here first. So how we like to look at things is you were talking about the rate. So it's like going to be like, oh, like, 7 point, whatever. And like, what happens when it gets sold? Right. But for the consumer aspect and understanding that they have the opportunity to buy down rate up to a certain point. Again, I like doing what's in the best interest of the client. So if the client can't close, then they have no other option than to work on their credit to get into place, and let's give them more of a competitive edge. So let's say somebody, and I'm going to make these numbers up because I don't know them, but let's say that 720 credit score gave somebody a 7%. But could you do the 580 loan? Yes. But what would like a 580 starting point be at?
Chances are they'd be
costing 3 points.
That's what I was going to say. I mean, you'd be
so
you'd
almost
have
10.
Yeah. I mean, no.
I'm sorry. Yeah.
So your example right here.
Yeah.
So let's call it the 740 gets the 7%.
Okay.
Right? Today's market. Now those aren't accurate figures.
Yeah.
But the lower credit score would yield you a higher rate, but you'd also have to pay to get that rate.
Yeah.
Right. And then that's where I'm going with it. So I'm not saying they're going to have the same rate,
Right.
but without paying anything, the worst credit score would have the higher starting point. Yes.
Absolutely.
So again, we're just making these numbers up, but I just want to put in perspective.
And rightfully so, because the other folks that have worked hard to keep their credit, all that jazz,
should
wasn't
get a
just
better rate.
entitled to good credit. I mean,
Right.
that's on you individually.
Right.
And nothing against folks that had things happen, because I personally have had things happen when I first started, and it's like, whoa, but knowing and understanding how to get out of it and get things right, that's what you're trying to educate folks with.
Right. And that's what I'm saying. So like, so consumers really quick, let me just say what they're trying to say is like, nobody's discriminating because you have bad credit and they're saying, hey, we're just going to make you pay more. That's not the thought, even though you think it. What it actually is understanding that the credit score is an indicator of the risk for the lender. Because remember, they are giving you the money for 30 years. So there's things that you do with your credit, and the lower the score represents the higher the risk. And the risk is around how you pay your bills. So rightfully so, they're going to say most people usually pay their bills in the very beginning. Like even the person with bad credit, when they get approved for the car, they're more than likely going to make all their payments in the first 6 months before they miss a payment.
Right.
And that's why they're going to collect all the interest up front in those first couple of payments.
Smart.
So where I'm going with this is I like to give people the level playing field of if they have, and again, I'm making this up, a 740 has 7%. And let's say a 620 has 7.5%. Again, completely made up, but just for the math.
Good visual.
Right.
Yeah.
It is.
So now they're at a 0.5% difference, and both of them have the opportunity to buy down rate. Well,
let's go back. Technically, the lower credit score doesn't have the opportunity to buy down rate. They have the opportunity to lock a rate.
To lock a rate. Okay, so that's even more of a disadvantage.
Correct.
Yes.
Okay, so let's just say, for example, they're both trying to figure out how can I pay less in the rate or just lock in what I have. Let's just pretend in this scenario that both of them, for whatever reason, can have an opportunity to do it for whatever reason. The starting point of the lower credit, they're already at the disadvantage by 0.5 point. So by a conversation with me, if I can change some of the financials and how your scores look just by even giving you a couple tips. I'm not saying you got to pay me for service,
right?
But if I said like, hey, maybe a good thing is let's get your credit cards from here to here, because when you lower the balances on there, you're going to drive the score. But then you're also helping in the DTI side, because the lower the balance, the lower the minimum payment. So you're doing both, right?
Correct.
So when you have somebody like me that's guiding your clients through things, I just don't understand where people are like, well, this is going to delay the process. If they're not qualified already, or they have the opportunity where they can save a significant amount of money. And it was, let's say, and again, this is not the normal scenario, just example, if 30 days made a difference where they were going to be able to save 0.5 point or a point. That's massive in a mortgage.
I agree.
Huge.
Right?
I agree.
That's $100 to $300 a month. Multiply that by 30-year mortgage, pending they keep it. You're talking a 6-figure savings on the home just by a conversation.
And I will tell you right now that with where the industry is, with where the housing market is, with home prices here and mortgage rates up here, every dollar counts.
Absolutely.
Yep.
So,
Absolutely.
So waiting 30 days to do a couple little tips that you provide will save thousands of dollars.
Yeah.
In addition, having someone like yourself in their process, no matter where it is, should be on the front end. But you can lead the horse to the water, but you can't hold its head down, and make it drink. And to that, I basically say some will, some won't. So what? Someone's waiting.
Yep.
Why? Because there are more customers that actually do want that advice. They will take that advice and act on it versus take the advice and go, let me go to another lender. I'm serious. Right. And that's just how that works.
Yeah. And here's just another part of it too is, let's say somebody needs to close. I get it. There's scenarios of, hey, this loan is pretty ugly, but we're happy that somebody bought it. And this is going to save someone who would have to go start renting an Airbnb because they're about to be homeless because they already sold their home and something happened. And now they get to live in a new home. I'm not saying don't help people get into the home because they got to own the asset in order to be able to refinance.
Sure.
I get it. But here's another part. How about after all of those clients who have closed that have been in those scenarios, when's the last time they were reached out to say, because guess what? Home equity line of credit, doing a HELOC and borrowing all this equity that you're bragging to people about that, hey, you can never get equity from your rental, but you can from what you own. Well, you can if you don't qualify because it's still a loan.
So true. And there's always an abundance of what we need when we don't need it.
Yep.
But then when we need it, there's never enough.
Yep. That was just, it was one of those, like, it triggered in my brain when you're talking about rates. And I'm like, man, like, see, like, my fight is to give people the best opportunity possible. And if it's like, hey, if you're not approved at all, I'm going to do all that I can to help you. And if you are approved and you're in a situation where, like, you can't wait, I hear you, but don't forget about me after, because my job is still to do all that I can to help you even after you make the purchase.
Right.
And so that's why, like, when I see things like this, I mean, I know it's a little bit of a tangent, but
well, not really.
I think it's a good tangent, though.
Yeah, and I think that as rates stay where they are, and I believe it's going to be for another 6 months to a year, and then steady out, we're going to see more cash out refis simply because we're at the highest credit card debt that the United States has ever had.
Yeah, what was it?
Over a trillion.
Something?
Over a trillion for the first time.
Just in credit cards.
Yep.
So therefore, I took 2 apps yesterday from cash out refis. I told them their rate, 7.5%, 8%, both. One was 7.5%, one was 8%. Sounds good.
Yep, because it's better than 22.
It beats the 22. It beats the consolidation loan at 17%. It beats, I mean, it's like, why not utilize what you've already earned.
Yep.
To get you out of this mess?
And one, I promise I'll let you do. I just didn't want to, because some people listen to that and they're like, see, this is why credit cards are dumb. This is why I love Dave Ramsey and blah, blah, blah. Let me tell you something.
I've been flying for free off of credit card points for so long.
You only pay that 22, that 29%, whatever, when you carry a balance past the statement date, right? So, you know, that's another thing. I teach people not just how to fix their credit, but how to understand it properly to say, hey, I don't want you to pay interest either. Let me show you a great strategy on what the trade-off is so you're not putting all your money to interest.
It's like breaking up with a relationship and they say it's not me, or it's not you, it's me, but I'm the credit card. So it's like, it's not me, it's you.
I love some of the things that Dave Ramsey talks about, but when it comes to needing a credit score to buy a house, you need one.
Yeah. I'm kicked out of a lot of his Facebook groups and stuff. Yeah. Oops.
But it's true, though. I mean, we see that a lot. I mean, you probably get a bunch of folks that come to you just to even establish credit.
Yes.
Right.
Yeah.
Because at the end of the day, I'll give you another scenario, very similar. There was somebody who was looking to buy a home and they said, well, hey, I have to at least settle for an apartment for now. Had all of the money available to do essentially, like in the car business, we'd call it a one-pay lease where you just pay the whole lease up front. I don't know if that's the same term or there's a similar term, but they were just like, hey, like, I'll pay for the whole lease up front. I have cash, and cash is king, right? Well, guess who didn't move into the apartment because they still need to qualify?
That person. Yeah, they need credit.
Yeah.
You can't just go sell Pablo Escobar stuff and think you can move in here.
And that's it. Yeah. No mattress money, right?
Yeah.
But man, I don't want to do too much on the credit side yet. We'll pause, but
let's
good.
Get back
let's pull back. Let's pull back.
Do you have some questions from there? Because I do want to talk about the builder aspect of this without pissing any builders off, because it's better to be pissed on. Huh?
I think it was the opposite. It was supposed to be.
It is.
Oh, man. All right, let's see. People were saying, man, this music has me pumped to go clubbing.
It was great intro music.
I agree.
We as leaders are responsible for everything our agents do or are involved in. There are too many e-brokers out there who are so far off from their agents, they aren't even involved in what's being done. It starts with strong and hands-on involved leadership.
I have to agree with that.
And I think that's across the board. I mean, I manage a wholesale department. We work with mortgage brokers all over the country. And there's a lot of mortgage originators that work for a mortgage broker that don't really know who their boss is.
Yeah, it's just them.
Yeah.
So working out of their house.
Correct. And I don't know who this is, so it must be one of your people, Jacob McGrath.
Yeah.
He says, dude. He says, lots of mid-thigh in this live video.
I'm glad. I was telling him earlier, I'm glad I put lotion on because y'all see my ass. Yes. That's awesome.
Let's see. And then so Bethany says, I know I'm pissing off some people, but if you are not competent in an area or have too many agents under you or do not even live in the same state, this is a major problem because there are too many agents out there doing whatever they want. Fun fact, Bethany is, she does a lot for the real estate community, not just as a broker, but she does a lot of teaching at Champions.
Oh, that's awesome.
Very good. So I'm sure she has a lot of insight for like real specific scenarios.
I don't disagree with her on that. I don't. But I will also go as far as to say that in an industry that is changing, is evolving, is more online than it is in person. And we're seeing that shift during COVID. It's not like our business died during COVID. As a matter of fact, it revved up even more. I can only speak from the loan officer aspect. My wife's a realtor, but she doesn't go outside of San Antonio, maybe one deal here or there from Houston. But from the lending aspect, I'm seeing more and more loan officers getting licensed all over the place. I have no problem with that. As long as you know the guidelines, it's mandatory in my office that you have a Zoom call with your customers at minimum when you provide their options, when you meet them. You've got to bring that personal touch back. And if the only way to do that is through a Zoom call, it's mandatory. That's what you got to do.
Yeah.
Right? Well, that's just building a connection with your customer. I mean, that's
which from the lending side, we have to know everything there is to know about mortgage products. From the real estate side, you should know everything there is to know about the home, the community, the surrounding areas, all of the schools. It'd be tough to do if you're not from the area. You're just basically putting your name on a contract.
Yeah. By the way, guys, I'm just looking for the DMs I told you about. I'm looking for that one like specific builder one.
Did you get mine?
Well, here's a crazy fun fact for you. So in March of 2020, there were 28,000 licensed originators in the state of Texas. 28,000. Wow.
Dang.
That ballooned.
I don't have that many affiliates. How do I do that?
So think about it. That's licensed LOs. That's not that's not including people that work for a bank or a credit union also. So 28,000. It ballooned. At its peak of last year was at 56,000.
Wow.
But that trend is already coming back down.
Oh, yeah.
So, it's roughly about 40,000 right now, per the latest Texas Department of Savings Mortgage Lending numbers. So people are getting out of the business.
Yeah.
It was easy when rates were at 2%.
Yeah.
Everybody got in the business. Now it's coming back down. So,
and I can see that number continuing to shrink.
Sure.
As the year progresses, just simply because
not enough loans.
Not enough loans, and the ones that are happening are finding out that they need to be advised by an expert.
Yes,
not just someone that can push a rate.
It's not a side hustle.
Correct. Yeah.
You got some love in my DMs right here. So somebody who replied to my story said, "No shit. If we all just do our jobs right, there shouldn't be any need to pay for others' business. Let me close your loan so you can have a paycheck and a referral. But what do I know? That's one thing Mark Jones has taught me that's been invaluable in my business. Those who believe and trust in me will continue to go full circle."
Awesome.
There you go. You can get that on a t-shirt.
Yeah. Yeah.
That'd be a big t-shirt.
It means a lot. I mean, it means a lot because it's the sword that I will die on, and it's the one that I'm going to stick to. And it may have been tough making that transition to pay to play to value only. But I've gone this far. So therefore it's like, it's working for me now. So you're either going to start doing it now and your day is going to come where you can drop it completely a year from now, 2 years, whatever that is, but you got to start somewhere.
Yep. So here's our first one. I wish the builders can be brought more under control also. Doesn't feel like a fair game, but I guess it is what it is.
And it shouldn't be what it is. This is something that I know that John has fought rigorously about, and we have tooted whatever horns we can about this, blown the horns, whatever you want to call it, sounded the alarms.
Do we have an alarm to click?
Yeah.
But the concept is, I've always been told they just have better lobbyists than we do.
That is actually a pretty accurate assessment. So, and this came back. This was an original HUD ruling, like before the CFPB. I mean, before Dodd-Frank. This goes way back. Oh gosh, I want to even say like 1984 or something along those lines. But HUD ruled that builder-owned, basically requirements to use mortgage companies or title companies is not a violation of RESPA because they are actually owned by the seller. The seller is dictating. It's not a service provider that's dictating it. It's the seller that's doing it.
So that being said, if we worked with this is hypothetical, but if we worked with a realtor consistently, we provided value, they provided value, et cetera. It's an ongoing relationship, and they happen to stumble upon a listing. Could that agent maybe ask their sellers to have the buyers utilize this lender in order to go through their financing because I know, like, and trust this individual, they're going to be honest with me, et cetera, et cetera?
Technically, yes.
Okay.
Because that is the seller saying, I want you to use my preferred lender. Let me rephrase that. They can't force you to use that person.
Right.
But they can say, well, if you're not going to use Mark, then I'm not going to pay your title policy.
There's
the difference.
There it is.
You could use whoever you want.
It's like strong arming.
But if you use Mark, it's my house.
Yeah.
This is my buddy. I'll pay your title policy.
Wow.
Yeah. So that's essentially what you get. And now the unfortunate thing is right now in today's environment, like the tables are turned a little bit, builders can, well, let's just say build a lot into the sales price of the home. And or maybe they have forward commitments on lower interest rates along those lines. But in the past, it's not always the case. Sometimes the builder lender is more expensive than what the borrower can actually get outside. But cash is king. Number one thing I see people needing in today's environment is cash to close.
That's right.
So, you know what? If they're going to pay $20,000 in seller incentives, have at it.
Now, you guys know what they're doing, right?
What are they doing? Tell us.
So essentially, they create a joint venture behind the scenes. And what you've seen, and I've seen it point blank, it's like they're so obvious. You can have no closing costs, but this lower price, or we'll pay all your closing costs and we'll buy down your rate, but the price is staying the same. Now, mind you, those incentives are supposed to show up on the closing disclosure because there is no way in hell that a lender is offering a 4 anything rate right now without paying down a substantial amount of points. So where the heck is the money that they're using to buy down these rates? Are they just getting their heads whacked off over there in the backside? No, that money is changing hands by way of a joint venture, kind of all hands in the cookie jar. And now you know that.
It would be curious to see if I wanted to come in and buy this house cash. Well, instead of giving me $20,000 in incentives, we just lower the sales price by $20,000.
Whack it off the house. But then the person no, I don't. And here's why. The person that just bought and closed at, let's call it $320,000, and you're coming in with cash. Well, wait a minute. You just bought my same house for $20,000 cheaper?
Because neighbors talk.
Yeah.
That brings me to one of these, and obviously you guys can expand on it. So somebody says builders are sellers. Nothing currently that CFPB could do per RESPA. Does RESPA need to change? Yes. Will it? No. Almost got it changed once, but the builder's lobbying power is too big.
There you go.
I agree with that.
There you go.
So, and it's unfortunate, but our industry, or mortgages in general, loan officers are more apt to pay towards a realtor pack or builder pack than they are their own.
Absolutely.
So it's
strange, right?
It's strange and bizarre.
We don't want to bet on ourselves in that aspect.
Right. So, I mean, imagine if you had all 56,000 licensed LOs in Texas given $100 a year.
Right.
imagine some of the changes that can be made with the laws. It would
Good
be, it would be
take. That's a
substantial.
good
It's a lot
point.
of dollars.
Well, I mean, imagine what it could do if we had it
Yeah.
big pool to go against all of these packs.
Right, because the only way you can fight things like that is with funding.
That's right.
Well, and unfortunately, I mean, DC, Trump is right. There is a swamp up there.
Mm-hmm.
And whether you're Republican or Democrat, not to get into politics,
Yep.
they're both equally as bad when it comes to what's in it for me.
For me.
So the irony is it comes back to pay for play.
Yeah. Isn't that
Yeah.
weird?
DC is one big RESPA
Isn't that
violation.
weird?
We're about to
The
get canceled.
Light bulb
Let's see. Okay, so yeah, some other people are saying this. Oh, but it's still okay for builders to offer $20K to the buyer if they use the builder's lender.
Yep.
Yes.
What the fuck? That's what it said. I'm just reading what it
Yeah.
said.
I mean, that's exactly right. We just articulated that. So play that back.
Yep.
You can it and use it to tell your borrowers. But the one thing that I like to still use at this point is it's always education based. But let's say the borrower that is purchasing that builder's home, getting all these incentives, is moving within the next 2 to 5 years. That's something that you as the realtor should make sure of, that you're asking to make sure that you're putting them in the right situation. Number one, because if they do happen to stumble upon having to sell that home, they're probably going to still be competing with that builder. They're not going to be able to get what they paid for it. And then the second piece to that is, if you were purchasing a pre-owned home, would you give that seller all of your documents? Would you give them how much, show them all your cards? Here you go. This is how much I have in the bank. So if it falls short of appraisal, you know that I can pay the difference. That's just one of those things that, are you truly protecting your customer, or are you going after the 4, 5, 6% commission?
Ooh.
I said it.
Ooh.
I'm just saying.
You mean choosing the builder for my borrower based on the seller consent, or the
Correct.
realtor
Correct.
incentive is a bad thing?
Yeah, like when I see people shitting on Lennar because the incentives are lower.
But
Do
then they
re-
love them.
Do they really build a shitty product, or is it because of all the stuff behind the scenes that has taken place? Because there was a point in time when no builder needed any realtors. They were
Just
lining up. Exactly. They were lining up and denying people if they weren't bullet credit, if they weren't have money in the bank, if they didn't want to pay over, et cetera, et cetera. So it's like people have this short-term memory about what has happened and what has been done.
So how, for the consumers, which, by the way, if you're just tuning in now, I just wanted to mention again, if you're watching this, please share it. If you have a comment, please write it. I'm checking the comments so we can talk about the things that you want. If you're watching this at any point, whether you're watching it on the replay, please share it as you're watching it. If you're watching it live, share it so other people can see it, because we also want to get consumer perspective, which is the next thing that I was going to go to. Because again, with it being streamed where it is from my Facebook, there's a lot of people right now that are looking to buy a home, and the realtors and lenders get what we're saying.
Correct.
And the builders get what we're saying. So what advice can we give a consumer, one, to kind of comprehend a little bit of what's happening, and then maybe give them some advice on how to be weary of, like, making sure you're picking the right realtor or lender to work with?
I think number one, you can't it's not a good idea to shop for rates until you're under contract. Number one. Why? Because you can't lock a rate. Let me take that back. There are very small instances where you can lock a rate without a fee before you have a property under contract. Why? Because we're reserving X amount of funds that are going to this investor at this rate, et cetera. I mean, I lost my train of thought on that.
Pick it up.
Well, I was just going to say, look, if you're currently renting and you're thinking about buying a home, I can't encourage you enough to do it, because, I mean, in this, just proven facts, right? Homeowners have over 40 times net worth greater times than renters. You think of all the issues that we have in our society, so much of it boils down to the difference between the haves versus the have-nots. And when you really extrapolate, like, consumer wealth in this country, the difference between white families, Asian Americans, Black families, and Hispanics, massive disproportions.
Absolutely. Yep.
The key driver of that?
Home ownership.
Home ownership and home equity. So I'd say, don't rush into it, but absolutely continue to dream about owning a home. And have some realistic expectations. There's nothing, I think, worse than a family getting into a house and then 6 months in being and realize they can't afford
They're
the
house
payment.
poor.
Right.
Right. That's problematic. There are still homes available. They might be a little bit further out right now. They might be a little bit smaller. Not everyone's ready to live like a Kardashian. So let's get some realistic expectations. And then that's where you're working with a good real estate professional is to, hey, this is what we can afford. I worked with my lender. He got me approved for this. And then, okay, what are my options? And then go start from there. So
you triggered something that I talk about quite often, which is when you are shopping lenders, maybe it was referred to you by the realtor because you went to them first. Maybe it was referred to you by some post or something like that. But I think we should start changing the mindset of I got pre-approved or pre-qualified. That in itself kind of pigeonholes you into, okay, they offered this program. I was approved for it because my credit, income, assets, etc. Instead, change that to I got my options. Why? Because you do have options. And I don't care who you are, what borrower, there's not just one scenario that this loan is going to be the only loan you can do. You have options when it comes to that. And if you're working with a lender that provides you one option, let's say you go to XYZ lending company and without doing any kind of face-to-face or Zoom or anything like that, they're offering you an FHA loan. Here you go. That's what you're getting. Well, why? Why not USDA? Why not conventional? You didn't even ask me if I was a veteran. Those kind of things is what I want consumers to know, that you do have options. Let's stop saying pre-approved for pre-qualified, because first off, mortgage loan officers can't approve anybody. We can only decline people. And it's basically from a credit aspect. But at the end of the day, if you are not exhausting your resources, doing your research, educating yourself, and the number one reason why consumers don't shop for their mortgage is because it's too confusing. They don't know. There's too many options. There's too much nuance,
and that's unfortunate. So that's where I love the fact that you steer your loan officers to require them to get a Zoom call with the borrowers. Correct. I love that. Because consumers, buying a house, it's a hell of a lot easier to go buy a car. Right? You're driving off the lot. That's
right.
Well, probably 3 hours, but
depends on your credit.
Depends on the credit. But options is super important. 92%, this is from the National Association of Realtors, in 2021, 92% of all buyers went with one of the first two LOs that they spoke with.
Correct.
So I come back to...
That's the stat that I'm using.
Yeah, so I come back to, find somebody local, get a personal referral, not one that was paid for.
Yeah, correct.
Right, but establish that relationship, ask questions, and figure out and ask what your options are. And I can tell you that, I've seen in 25 years of doing this, I've seen literally tens of thousands of credit profiles in loan application scenarios, and not one or two are
not
alike.
The same. Yeah, it's like a thumbprint. Different. Everybody has a different one. That's exactly right. I think, gosh.
Oh, and be careful for trigger leads.
Let
me throw that one in there.
If your company hasn't started using soft pulls on credit, you're behind.
So
can you explain to the people?
Yes. So what a trigger lead is, and this baffles my mind. We talk about lead generators and stuff like that. So it is legal for the three major credit repositories: TransUnion, Equifax, Experian. These are publicly traded, giant, big
independently
data,
owned,
and, publicly traded companies that are basically selling you. They're selling your data. We're all worried about privacy these days, right? Well. So if I go apply for a loan with Mark here, and I know you do soft pulls, but let's say you did a quote unquote hard pull.
We didn't before. We were like, how the hell do we stop these trigger leads?
So when you get your credit pulled, immediately, like within nanoseconds, the credit repositories have already sold your name, your address, your cell phone number, your email addresses, maybe even your profile.
Yep.
They're selling like what your credit score range is,
correct,
where you live, which could possibly get into some fair lending issues. There's all kinds of stuff. But bottom line is, guess what? They're selling that out there to other people. And so now the trolls are coming out of the dark, and they are going to spam you to death.
And these are the folks with the least amount of value. Why? Yes. Because they're canned messages or canned scripts that say, we can beat whatever rate you're being offered right now.
Right.
Well, what if I wasn't offered a rate? What if I have 580 credit score? You know what? Beat it. Yeah. But nobody thinks to ask that. They just get sucked into the bait.
Yep. And I'd like to offer one thing just from the credit perspective of the hard pull versus the soft pull. And there's a common misconception. So I hope that I debunk it now with everybody that's watching, what the difference of a hard pull versus soft pull is. Some people were under the impression, and we do this through various classes and stuff, and I discover like people were like, oh yeah, the soft pull, you don't just get as much information on the credit report as you do a hard pull. And I'm like, whoa, who told you that?
Yeah.
So I just
we get to see it all.
Because like that's very discriminatory there. Like think about the practice and the trouble they'd be in, because who would select what they would want to show the lender or not show the lender? So if you have somebody that is telling you the difference of a hard pull versus soft pull is how much information is given, it's not true.
Right.
The difference is the hard pull has a finance application attached to it, because now you're actually applying to borrow the funds, which is another indicator of that risk, because how many times you ask to borrow money matters.
Yeah, that's right. And essentially the consumer can pull their own credit as many times as they want without it affecting their score. So this is the same concept is we're taking a peek into your credit at your request, but we have not offered you any terms to this mortgage.
Right.
That's a good point.
If you don't want to get spammed, please go to opt-out pre-screen.
There you go.
Yes.
And then they'll sell you to somebody else.
Yeah. I mean, shameless plug. I mean, I guess I could do it because it is my Facebook. So part of the credit monitoring that we have, so it is James Warren Group Credit Monitoring. And now I'm sure you saw like the app, right? So we were able to develop the credit monitoring in an app. So now we can compete with like MyFICO and Experian and things like that. And two of the things that happen, one, you can opt out right from there inside of ours. And then part two, you know, when you get those indicators of like, Experian usually says it like, hey, your info is on the dark web and you're at risk, but they don't tell you what it is and how it's at risk and what to do about it. Well, in ours, it'll show you exactly what information is out, who exactly has it. And with a click of a button, you can immediately say, I want it to be removed. And within 1 to 45 days, we'll give you the confirmation when we have removed your stuff. And it's weird stuff. It's like peoplefinder.com and publiccourtrecords.com, all these weird third-party places that the bureaus and also the places like that people don't know, like LexisNexis and Innovis and all these other things you've never heard of. This is where they're sourcing that information. There's technically over 330 different bureaus that exist that house information. So we have that all in our app to remove those things.
That's good.
So you don't have to worry about those spams and you can opt out immediately. And there's nobody who can validate information that wasn't yours if it doesn't exist because it's not being hosted somewhere else.
Yeah, no, that's a good point. I think all of this that we've been talking about in a summed up scenario is you've got social media that we were all wondering, how are they going to make money back in the day, right? We've got credit monitoring systems. We've got MSA agreements, desk rentals, pay for play, all these things. And we're wondering, well, where's the value? You're the value. I mean, at the end of the day, we're all paying for you. So that being said, why not take that concept and start believing in yourself, right? Take the next step to getting your credit in line, take the next step to providing value externally to those around you. I think that's something that we don't trust in enough is ourselves. Is there anything else you guys want to add? This is a badass show.
I love that. I mean, I think, you know, particularly if you're a consumer, you know, take that kind of stoic approach if you can, that if you're not able to buy a house today, it's like, it wasn't meant to be today, but help me, work with professionals that can get me on the steps to prepare to where I can buy a house tomorrow.
Right.
Because that really should ultimately be your goal, transgenerational wealth creation through home ownership.
I agree. Before we head out, guys, realtors, if you are local San Antonio, we are doing an appraisal class, super in depth about all the changes, text that's being added to it. Tuesday, the 29th, it is going to be at Vision Title, from 11 a.m. to 1 p.m. We'll be providing food, value, all that good stuff. So make sure to go to our Facebook page at I Think Mortgage. Key factors, man. We got some good ones in here. Yeah. Well, I hope you guys learned something from this. If you don't, me and Dylan will probably hit you with some more stuff next week or the week following. Other than that, we really appreciate you. Hopefully you share this, like, subscribe, all that jazz. But we will catch you on the next one.
Adios.